This is not a webinar about why short-term rentals work. It's about why deals that look stable on paper often don't perform the way investors expect. If you've looked at a short-term rental deal recently, most of them look similar on the surface. Strong demand, solid projections, good locations. So the real question is, where do they actually break? Quick note, this is for educational purposes only. Any actual investment details are only shared with verified accredited investors through a full PPM. Hi, I'm Bajan, U.S. Navy vet with over 24 years of experience in IT and 17 years of experience in real estate. Brad, my business partner and co-founder of Indomitable Horizons, brings a rare combination of an engineering degree, an MBA, and 24 years of combined real estate and stock market investing. Has a track record of saving Fortune 500 companies over $850 million through high-stakes problem solving, and he brings that same analytical firepower to every deal we touch here at Indomitable Horizons. And now our superstar, Deanna Lee. Deanna has a quiet gift for knowing when to move. She built a long-term rental portfolio and began transitioning out at the peak in 2007. As the market found its bottom in 2009, she was already building a short-term rental portfolio. When property values climbed through the COVID era, Deanna liquidated thoughtfully and diligently, maximizing profits and turning her attention to what was next. 2 cycles, 2 pivots, always at the right time. Along the way, something became clear for her. She wasn't just passionate about real estate. She was passionate about the people, about the difference between offering someone a place to stay and offering them a memory they can carry home with them. So she began building her new portfolio, luxury destination rentals. Properties carefully curated around the exact feeling, not just near an attraction or an experience, but the experience itself. Let's start with some facts. Travel demand is strong across multiple markets. The global STR industry is estimated at $154 billion in 2026 and is projected to exceed $408 billion by 2035. That's a 2.5x return in 10 years, growth, for an entire subcategory of real estate. Places like the Dominican Republic, Mexico, and Hawaii are key to STR, and I'll explain why in a bit. New formats like glamping and tiny houses are also expanding, which we will also discuss further. So this is not a weak demand environment. Okay, so Mexico, DR, and Hawaii are all #1 for American tourists. How is that possible? Well, Mexico is the #1 outbound travel destination overall. DR, Dominican Republic, is the #1 destination in the Caribbean. And Hawaii is the #1 domestic destination. How about that for demand? But most investors look at demand and assume the deal is protected and safe. If people are traveling, if occupancy is strong, then the investment should work, right? No, demand is not a promise of performance. Most deals don't break because the market isn't strong. They break because operations don't match projections. Top 5 reality checks for an STR deal: seasonality, regulatory risk like zoning and permits, supply oversaturation and competition, operating costs and learning curves, all led by guest experiences and reviews. Here's how this shows up from your side as an investor. At first, everything looks fine and distributions start to flow. Maybe they're a little below projection, not enough to feel bad about. Just enough that over time, the math doesn't line up. Timelines stretch, stabilization takes a little longer, exits get pushed, and again, nothing feels broken. This is just how investments go, right? But me as an investor, here are my thoughts. The market hasn't changed and the demand hasn't changed. So why are we not getting the projected returns? Well, here's the challenge in reality. Strong demand can hide weak execution, at least for a while. On paper, everything looks stable. There are no obvious red flags. And investors and limited partners, they don't see the day-to-day operations. So problems build slowly and out of sight. This matters more now than it did a few years ago. The gold rush era of STR is over. Demand is still high, yes, but competition and supply is catching up. Tulum, Mexico supply has grown 98% year over year. DR supply grew by 31% over the past 5 years. Demand after COVID covered a lot of these gaps. That's just not the case anymore. Global STR investment is clearly rising, but the money isn't spreading evenly. It's flowing toward deals that already work. And that widens the gap between strong and weak performers. Selection has never mattered more. So, the question isn't, does STR work? The question is, how do you tell which deals will actually hold up? And that's exactly what my co-founder Brad is going to cover next.
So what work needs to be done after you read an operating memorandum? You need to ask yourself, where can the projections break? Where's the risk after my capital is locked up? What assumptions are being made? And can this operator actually perform? Map the risks and always verify alignment. You should win when the operator wins. So here's the work you need to do after you read the operating memorandum and before you lock up your money. Verify market demand. Yes, demand is abundant, but what about in that specific neighborhood for that property type? What happens if the nearby attraction isn't available, like no snow on the mountain or seaweed up on the beach? And then underwrite. Are the expenses and incomes probable? Are they conservative? Has the operator done it before? Or are they learning with your money at stake, not theirs? And does the operator pass a background check? We know every deal has risk, or we wouldn't care about being diversified, non-correlated with asymmetric risk reward. But is there a risk mitigation plan in place? Does it make sense? Can the team solve problems when they arise? Have they done it before? Have they solved problems when they arise? And then alignment. Does the operator get a big upfront fee like 5% or 7% and no back-end reward? We've seen this. How does the operator win, and does that align with the LP's success too? And then structure. Is it legal? Is it compliant? Have the permits been pulled? What about zoning and HOA approved? Is it a syndication? Who's going to be managing your investment after you wire the funds? So these are 5 questions that we answer on every deal that we look at. So for short-term rentals, we use websites with subscriptions like AirDNA to verify the current average daily rates in the area. We can also check crime rates and neighborhood income with city data, verify population trends and traditional market analysis in addition to short-term rental specialty metrics. And then underwriting. Run your own numbers down the spreadsheet. Make sure you're using short-term rental numbers because they are different than long-term rentals. And do underwriting on the operator too, including a background check. For risk, look at other properties that the operator runs and ask for what has surprised them. How did they handle it? Most importantly, try to figure out when things get scary, will this operator throw investors out of the boat and save their own skin, save their own capital? Or can we all cross the finish line together? And then alignment. Verify that there are rewards for the operator and the capital raiser at the end of the deal when you win too, not just the beginning of the deal. Ask your friends or partners to do their own analysis and compare. Did they get similar or same results as you did? And then, of course, legal. Check the zoning, the permitting. Is it legal to run a short-term rental in that location? Check the PPM and compare that to the operating memorandum. Do they match? If a deal can't clearly answer these 5, it's incomplete. Pass, skip, just move on. So most deals look sexy up front because salespeople know how to sell. That's just the brutal truth. But performance misses projections because of operations. And the risk is real. Do any 5-year plans go 100% as expected? So the real question is, do you know where the risks are after your money is locked up? Is there a mitigation plan in place to protect your investment? Is the team experienced, prepared, and capable of solving problems as they arise? Have they done it before? Is this the deal in the team that is worth investing in? And always remember, ask better questions, get better answers. So here's a real life example that has passed through all of our filters, as well as 6 additional independent investors that are not on our team. So yeah, you got that right. Remember when I suggested earlier, get friends or partners to do their own analysis? I think we have worked with, including ourselves here, 9 people have independently checked this deal. So the market, guess what? No surprise, demand is strong. But it's not just in the state or the country or the area, but in the specific area and neighborhoods where the properties are. There's 8 different properties generating revenue already today on this one. So for underwriting, we're not just looking at projections and comparing that to what might be. We can look at what already exists, and that's very rare for a short-term rental deal. We can look at the operator's experience, and spoiler alert, the operator on this deal has 782 reviews with an average of 4.92 stars. They also passed our background check. So risk, it's spread across multiple markets, so performance isn't tied to just one property or one variable being perfectly right. And there's also income insurance on every property. So if there is a hurricane, the income is covered until the property is rebuilt and back up to speed. And there is a detailed risk mitigation plan for many factors that could go wrong. I talked about 5 or 7% acquisition fee. This one has a relatively small one at 2%. The operator intends to operate the assets after the deal is over. So there is alignment in the incentive for the operator to do well with these properties because they are going to have the properties when we are out of the deal. And then legal. We've gone through lots of operating agreements for LLCs, syndications, PPMs, and lots of other documents have been verified with lawyers involved. So this is what it looks like when the process is applied before capital goes in and all of the categories, all of the filters get passed. So instead of relying on one property or one market, we have an entire portfolio. So the risk is spread structurally. Also the properties, many of these properties are up and running already. So again, it's not just projections, it's what is actually happening. And we are diversified, non-correlated with asymmetric risk reward. The risk is spread across multiple properties, multiple markets, multiple formats. Seasonality, right? Some of these properties are snow season, some of them are beach season. Weather patterns, whether they're Atlantic weather patterns, Pacific weather patterns, Gulf Stream weather patterns, and of course, vacation types, from beaches to mountains, lake houses to glamping, private condos to resorts. It's designed, curated, and structured purposefully to hold up across a variety of challenge because you never know what's going to happen over the next 5 years. So at Indomitable Horizons, we encourage you to build your own mural of investments. Again, mural stands for marketing, underwriting, risk, alignment, and legal. And we filter a lot of deals. Most deals do not pass through all of our filters. When they do, we invest in many of them, oftentimes before any of our investors do. But after it filters, after we invest, then our investors, our clients, get to build their own portfolios with the ones that pass our filter because they get to choose which deals they want to go in and also how much to allocate. And because we are structured as a 3C, 5C fund for real estate equity deals, like the one I just discussed, we have to have a GP position. So we are at the management table for the lifetime of the deal to protect your investment and ours. So what's the takeaways from today? Demand is strong, but that's just the glitter sparkle bomb that gets everyone excited and distracted. What really matters is after your money is wired, are the operations ready to go? What happens after your capital is committed? A lot of that isn't visible up front. That's why you got to do some digging. That's why you got to get in with the details. It's also why the gap between deals is starting to widen, right? Institutional money, Marriott and Hilton especially, are getting into this space because they see a lot of short-term rental operators are not doing it right. There's room for new investors, and there's room for the investors that are already in to do it right, to exceed expectations. So what are the next steps? If you want to discuss further with Bijan or myself, you can schedule a meeting with us at indhrs.com/contact or scan that QR code. We'd love to talk about the short-term rental deals that you're in. Are they going as expected? If not, maybe we can talk about why. Maybe we can look at some of the risk factors that are coming up. If you're looking at a deal, we'd love to look at it with you. And if you're interested in some of the deals that we have available that have already passed our filter process, any of these three are things we'd love to discuss with you. So again, indhrs.com/contact, and then our QR code is there. And then once again, this is not an offer to buy or sell any kind of security. This is just for education and hopefully some entertainment purposes only. But any offers, the terms will be documented through the PPM and or deal disclosure. So grab that QR code, go to the link, schedule a meeting, and then we have a special guest. Deanna Lee was able to join us, and she's just been doing a tour of some of her Latin American properties, short-term rentals. And I'm going to turn it over to you, Deanna. What do you have to share with us today?
Hi, amazing. That was a great presentation. I wrote down some key points here that I think would be helpful to speak to, because I'm in the middle of it, right? We can talk about hypotheses all day long, but let's talk about things that are happening right now, because it's so true when you say the demand is strong, so it must be fine, right? I went into that a long, long time ago thinking the same. Well, if there's demand, it must be fine. And the first one I bought was the Hawaii property a while back, and it just went in looking at, hey, there's demand. Why wouldn't everybody want to come to Hawaii? And, we had plenty of competition, and those were things I didn't think of. And so when you're a beginning operator, there's a lot of things that you don't think about until you've been in it for a while. And so I love that you speak to that, because it's easy also to tell a story, to spin the story in any way that you may want to, right? Like, hey, if I'm wanting to say that the demand is strong in the Dominican, which it is, or the demand is strong in Hawaii, and we can change those stories however we want to, right? And so that's why it's important for people who are just getting started and looking at these deals to understand. It's just like Bijan was saying, well, Mexico's number one, Dominican Republic's number one, Hawaii's number one. Well, how can they all be number one? We can spin a story however we want. And that's why people like you're teaching right now need to get into that nitty gritty. Does the operator have a risk mitigation plan? Yes, we do. Do they know some of these other things that could happen? What's going to happen if there's a hurricane? What's going to happen if 2020 happens, right? And so I would like to speak to that risk mitigation a little bit, because the fund that I have, that the opportunity that I have, which I'm not here to pitch any of that, but the opportunity came from a risk mitigation plan. It came from knowing that the market was going to shift. And in our risk mitigation plan, one was the market's going to shift. What do? We deleverage debt, we bring on equity partners, we do some of these things, and we followed those steps. And we followed those steps before the market shifted. Right? Same thing with, rewind a little farther. We had a risk mitigation plan in case of a black swan event. Most people think black swan events are, a hurricane or some act of God, but it's also a pandemic. And you guys all know what happened, in 2020, and we owned properties then, and we already had a plan. So when everybody else was scrambling, like, what do we do? What do we do? What do we do? We said, oh, it's time to pull these levers. Anything that's a short-term rental goes to a long-term rental right now. While everybody else is scrambling and trying to figure it out, we were already putting things in place. Those are the reasons why the risk mitigation plan is so important, because looking at my notes from what you guys said, it's not if, it's when. It's not hope it doesn't happen. It's plan for when it does, because it will. You guys, especially the more and more properties that you have, hopefully with an experienced operator, the more things come up, especially the more destinations, the different things. But that's also a good thing, because if you have different destinations, like you said, then if something comes up in Mexico, which is the #1 destination, but we also have media, and the media gets to choose what it wants to focus on. And a lot of times it's not what we want the media to focus on. So that has a little dip. But when you have other properties all over the world in different economies and different markets and different seasons, that might dip for a minute until the media gets distracted by something else. And so we have these plans in place. We are, we make sure that we have that diversification across seasons and economies and those things. So that's just me speaking to that risk mitigation. I think that's so important that you guys talk about that. And what's crazy is that that's just one of the 5 things you guys check. I can also say that when these two, when Brad and Bijan both invested in the opportunity that I have never had anybody do as deep work. And I loved it because it made me better. They're looking at my numbers and some things I didn't know, and I have no problem telling people I don't know. And then I went and found out, and then I got them the answer, and just over and over and over again until they finally said yes, and it was amazing. And so yes, the work that they did there made me better too. So I think that those are some really important things to speak to. The other thing that I wrote down really was that stabilization period. I think it's part of in the assumptions, right? A lot of times people will just give those projections. And some of the challenges we run into as well is because we are operating. Brad said it. We have 8 that are open. We have 3 more that are coming soon. We're in it. And so sometimes if we're in the beginning or in the stabilization period, the numbers don't look as awesome as like the 40% that you're going to get down the road. And so you go in with a new operator and a new fund and new shiny objects, and look, everything is going to be great and shiny. Let's see if you can try your own assumptions. So when we created our projections, we actually make it so that our people that are looking at deals, they can change the assumptions. I may base all my numbers on a 75% occupancy rate. But anybody looking into my deal may say, well, what does it do at 20? And our spreadsheets are built so that they can change the assumptions however they want, not based on what I think, not based on my experience, but based on their own assumptions, and see if it passes their sniff test. So those are some of the things that came up when you were presenting that I thought might be important to share. Is there anything else?
That was awesome. You should have spoken first. Bijan, any questions or anything for Deanna?
Where are you at now, Deanna? Your background looks fantastic. Looks like
Amazing.
someplace I want to visit.
Coming soon. Yes, this is Southern Utah. We have a family cabin here in Southern Utah, and right next to us is 123 acres where we are building a beautiful luxury glamping retreat this summer. We expect to have this. We're working on the horizontals right now and breaking ground, and really excited to go vertical this fall. And I cannot wait to share you guys with this. It's called Nebula. We're going to be doing some pre-marketing campaigns and everything. So keep your eye out for that. But that is also part of the opportunity. And it's really an amazing space. Oh, and we're in Southern Utah. I didn't even tell you that. I'm in Southern Utah, halfway between Zion National Park and Bryce Canyon and Bryan Head Ski Resort. So what we call a golden triangle. And with this project, this is one where we rezoned it. We were coming in with temporary structures. And that's some of the stuff, that's part of a risk mitigation too, right? We had the plan worst case scenario. If we can't rezone this, we can still build 14 temporary structures, no problem. But then we were able to rezone and do permanent structures, which just increase the possibilities. So like, I don't even know the word for it, but we're just super excited to build this and build it out and share this with everybody. It's experiential. Again, there's that strong demand. You mentioned that with Marriott and Hilton. Hilton just bought Marriott bought postcard cabins. Hilton bought under canvas. The big names are coming. We got here first. So I'm super excited to share this with you guys when we're ready.
That is very exciting. Thank you again for taking time to join us today. I appreciate it.
Absolutely.
Yeah, as you were talking, I just kept hearing that saying, what's the 3 most important things in real estate is location, location, location. And you've actually crushed it. And well, you have been crushing it since the early 2000s and probably before that as well.
Yes, I've been dreaming about this, since I was in my 20s. So yes, and the dream to reality. And now it's all, it's all coming through to fruition. And we've had our challenges, but this isn't the first one. Like you said, this is the third portfolio. This isn't our first time. And we've built a rinse and repeat model. That's super important because it's a rinse and repeat model that we can duplicate in any destination we choose, from the Caribbean to the national parks. It's not all the same. We have challenges throughout, but a lot of people think, oh, the challenge is building. The challenge is not building. It's what happens after. Everybody's like, oh, I can remodel a hotel. This was me 3 years ago. Sure, I can remodel a hotel in a developing country. Why not? How hard can it be? We'll talk about that later. and then it opens and you're like, oh, now what? I mean, I knew what I was doing, but there's still so many little nuances that you didn't know until it was time. And now that we've done a resort in the Caribbean and we're doing a resort in the national parks, and this model is repeatable over and over again. So we're not reinventing the wheel every time. We're just, let's do it. And what's the next place? What's the next one? So the snowball effect is pretty exciting.
Fantastic. Yeah. Well, thank you, Deanna, for being here. Bijan, thanks for your words, and to who's watching this video, thank you for watching it all the way through. Again, you can reach out to us at indhrs.com/contact, and always invest on logic, not on hope.